Welcome, everyone, to the best ever investment property insights straight from the pros. I'm your host, Trevor Henson, and today we have the great fortunality to meet with one Mr. Fred Gortner of Paladin Realty Partners. Fred is the founder and COO now, correct? Is that correct? COO?
Mm-hmm.
And I believe Paladin's been around for quite some time, correct?
Almost 30 years. We're coming up on our 30th anniversary. It's kind of hard to believe.
Wow. Congratulations, by the way.
Yeah, thank you.
Real estate entrepreneuring for 30 years is some grit to it, sir.
Yeah.
So without further ado, we'll get started with our first question, and that which is the soft pitch. It's, how did you get started, Fred? How'd you get started in investment real estate?
Well, gosh, I've been doing it for nearly 40 years. I started out in the 1980s as a lender. Got out of college, went to a big money center bank in New York, worked there for a few years, kind of realized that it looked a lot more fun on the other side of the table. So when I came to LA in 1988, I came here to attend business school. Probably the best thing that came out of business school was I met my bride of 33 years there. She sat down right behind me on the very first day of orientation.
Wow.
But I also became a real estate investor and an operator. It happened when I formed a property management company while I was in business school in 1989. Wow. With a dear college friend of mine, fraternity brother, and around his family's real estate holdings. And most of those were older Class B, Class C apartment buildings here in LA. As I look back, it's a little astonishing that his folks let the two of us take over the management of their nest eggs. We were in our, 20-somethings at the time, complete rookies, had no idea what we were doing. But we kind of taught ourselves the business, and one by one, we renovated and repositioned each one of those properties. We upgraded the units, we increased the cash flow, and that portfolio has been an ATM machine for the family ever since. So, and I compare notes with him on a regular basis. We get together, and he loves watching what we're doing at Paladin, which is, pretty much the business he and I were doing almost over 30 years ago.
Wow. So that asset is still with you.
Yeah.
Wow. So then that would lead me into my next question was, that was your first deal on this?
Well, so, those were around his family's holdings. And so in 95, I co-founded Paladin Realty with Jim Worms. And, Jim's a veteran of two big global real estate firms. He's has the gray hair in the organization, so he provides the much needed adult supervision. Paladin is a SEC registered investment advisor. We're a institutional fund manager, and we're a boutique real estate investor, and we're focused mainly on what we call workforce housing across the Americas. So it's market rate but affordable with a small a housing all across the Americas. And the very first deal that Jim and I did when we started Paladin were value-added apartments, and it was just like I was doing with my college buddy back in 1989. And we ended up growing that U.S. value-added apartment business pretty successfully over a 3-decade span. We've done over 90 investments across the U.S., over 15,000 units, almost $1 billion in total cost. And,
wow.
and half of them were here in SoCal. And, if you look at across, I think we've done about 7 billion of real estate in 8 countries in North and South America over the last 30 years. These value-added apartment investments have been by far the most successful strategy for us across that 7 billion.
Tell me a little more about for the folks that don't know what the workforce housing and how I noticed you decapitalized the A and affordable.
Yeah.
I know what the difference is, but that's the first time we've heard the term on the show. If you could elaborate a little bit for the audience.
A good question, Trevor. So a lot of folks, when they think of affordable housing, they think of government subsidies, and that's what we call capital A, affordable housing. And that it's a pretty active business here in the United States. It's also, there's a fair amount of that down in Latin America where we're at. And but that's not us. We like market rate housing, but targeted at lower income and middle income buyers and renters. And so that, you know, in the US, that is a teacher, it is a cop, it is a fireman, it is a construction worker. It's, you know, it's the working class, middle class households who we're trying to provide affordable housing to. And that's, you know, it's really an essential need in both markets where we're active. Down in Latin America, we're a big home builder of for sale product. Here in the States, we provide, you know, modern but affordable rental housing.
Got it. And so, and you provide that through the value add.
Correct.
Approach. Exactly. Okay. Awesome. Great. And then, Fred, that leads me to my next question. Then, what was your most significant deals of all these $9 billion worth of deals? What was your most significant to you personally?
You know, the one I think, you know, they're all kind of somewhat cookie cutter, but I think the one that stands out is a portfolio acquisition that we closed at the end of last year, because just about everything that could have gone wrong with that deal did. It was 3 properties in Azusa totaling 116 units, really right down the center of the fairway of our value added strategy. You know, 30 to 40 units in size each, run down. They were underperforming their market potential. And so, and we preempted the market. We put that under contract before it came to market in January of 2022. And while we were in escrow, all hell broke loose. We had a war breakout in Europe. We had the Fed start to hike interest rates through the roof. We had 2 lenders blow up on us in the middle of escrow. We had to replace our institutional equity partner in the deal. So, I mean, literally everything that could have gone wrong while we were in escrow did. But we, you know, perseverance is one of those core values that Kyle and I have talked about, and we persevered. We got it closed in the 3rd quarter. We locked in fixed rate debt in the mid-4, so really, in hindsight, below market rate debt, 150 basis points below market. And you know, we brought Beachfront in to lead the charge with our renovation plan, and to date we've upgraded over 50% of the units, and the NOI is poised to increase significantly. We have a waiting list of existing tenants who want to move into an upgraded unit, which is one thing that Beachfront is really great at communicating our plans to tenants. You know, we pride ourselves on being a good landlord, not a bad landlord, and really trying to improve the quality of the living environment for our tenants. And we've got a good portion of the units we've already upgraded have been folks who were existing tenants who moved into an upgraded unit, and we've got a waiting list now. So I think at the end of the day, it's going to be a successful investment. But boy, I tell you, Trevor, last year there were several times where we're big on $1 bets in my firm. I think it's from that movie Trading Places, and I had a lot of $1 bets. I was like, we're going to close this deal. Trust me, we're going to close this deal. Like, yes, I know we got another curveball throw, but we're going to close this deal. And I'm glad we did, because it'll end up being a pretty successful investment for us.
That's hindsight is always funny and amusing, isn't it? It's always great. By the time you're like,
absolutely.
Escrow gets extended day by day by day. It goes on for 2 months like that. I'm like, I can feel that right here, because I've been there. I know.
You know, we were lucky that I happened to personally know the seller, which is not normally the case. He's in my ULI council, so I saw him at least twice during the year, and you know, brought him up to speed. So there was a level of trust. I mean, our firm's been active in the market here for 30 years, and we're an institutional brand name, so we've got a pretty strong brand. But this was also one where I had a personal rapport, and my partner Jim Worms did too, with the seller, and so that helped us. You know, it ended up being a 7-month escrow, and we couldn't have gotten that, I don't think, without that, that personal rapport and that trust.
Right, because 7 months is not typical even in the institutional world, pretty much. I'm
but he knew. Look, the whole world was changing while we had it under contract, and the seller knew that, and they knew that, we had a better shot than any other buyer that he was going to be working with to get that deal closed. We had two institutional partners who we brought into the deal. We had our debt. we went through 3 different rounds of debt, but we finally had the debt inked. So he accomplished his objectives. He got the price he was looking for, and we got the price we were looking for, and the financing, and off to the races.
Oh, fantastic! Sounds like it actually ended up well for both parties. It sounds like, aside from the 7 months of hair loss and stress.
Exactly.
But that's the game, right?
Yep, it is.
So tell me, Fred, what does your portfolio look like today? I know you brushed over some, but what is it? What is you?
So the night we were net sellers for many years when rates and cap rates came way down, and we were kind of waiting to relaunch and grow our acquisition activity, which we did about 3 years ago. So we're currently managing 7 assets, about 250 units. It's a smaller portfolio than we're designed for. They're all in the 20 to 50 unit range, mostly statewide rent control, AB 1482 properties. That's our primary focus. There's a variety of reasons for that, but we think that that's the best place for our business to be focused. And we're aiming to grow our portfolio here to $500 million to $1 billion over the next few years, with a combination of institutional relationships that are which we've got many, but also high net worth and family office investors who I think this strategy is pretty attractive for.
Hedging against inflation is what we see a lot of our clients trying to just get money out of banks so it stops depreciating.
Well, there's the inflation hedge, and there's which AB 1482 helps provide a good protection for that, but also there's tax benefits, there's the hard asset nature of it, the cash flow producing, and the fact that we're in a supply constrained market, chronically supply constrained market. All those things are positive. So
then, Fred, are you mostly with mixed? Is multifamily? Is that your focus? Is that where you're? Is that
in the U.S.? In the U.S., that's 100% of our focus, and in Latin America, workforce housing is probably 90% of what we do.
Got it. And is there a reason why you like multifamily over commercial, or like office space and retail?
So it's a good question. I mean, if you look across that $7 billion of real estate and 30-year history of Paladin, there is a common theme that runs through all of it, and one is that we invest in real estate that fills an essential need, and workforce housing is one of those. You have to live somewhere. You can't not live. You can choose to office via Zoom or office in an office, but you have to live in a place that you can afford. And the other common theme is we target chronically supply constrained markets where there's really good visible demand drivers, but where there is a higher barrier to entry and little competition from institutional capital. And that gives us all of that combination gives us a competitive advantage over the mom and pop investors that tend to dominate those markets. And we have a cost advantage over rents and over our going in cost basis. We're at, here in SoCal, we're at 50% of replacement cost after our renovations. Our rents are anywhere from a third to 50% below Class A. And, half of those 90 prior investments that we've made over 30 years were here in SoCal. They were among the best performing. And I think one of the reasons for that is that the SoCal market has kind of a uniquely asymmetrical risk reward profile for our strategy that you cannot replicate in other U.S. markets. And we speak from experience. We've done over 4 dozen investments outside of Southern California. So we have the perspective to draw that conclusion. And, if you know how to increase NOI through a value-added strategy, you get richly rewarded in a market like Southern California, which historically has low cap rates. You get a 20 to 25 times value appreciation for every dollar of cash flow that you can increase. But because this is such a supply constrained market, and because of the value proposition that Class B and C assets provide relative to Class A, you have, and because we tend to capitalize things very conservatively, it's rare that we are more than 50% levered, and we always use fixed rate financing. Those things all conspire to provide downside protection that you cannot replicate in Austin or in Phoenix, in Dallas or Atlanta. All markets that are good markets, but it's much more about market timing there than it is about long-term preservation of equity and downside protection and things like
that. That is a very logical and impressive approach, Fred. I've not heard it explained that way, but that's a very most people are arguing the opposite of like California, right? Here's all the reasons why not to invest in California. I think you are the first one that gives we've had on the show that's give a very good argument as to why California is sounds like more of a long-term hold, because it's not as reactive to the cycle.
Correct.
If I'm hearing that correctly.
That's very true. It's not immune to the cycle. I mean, we've already seen cap rates go up approximately 100 basis points over the past year. But we've also seen, NOIs go up by over 50% on our portfolio. So it's all
moving together, right?
Yeah, they all work together.
Well, thank you for that very succinct answer, Fred. You don't have to take that up and use that.
And we made a lot of money in places like Phoenix and Austin. And actually, I think the next couple of years, but you've had cap rate swings in Phoenix of 200 to 300 basis points. And it never made sense to me why the same apartment asset in Phoenix would trade at a 3.5 cap and it would trade in SoCal at a 3.5 cap. It just made no sense given the supply side risk that you face in Phoenix. And, you don't have nearly the discount to Class A and replacement costs that we have here in LA. So, and the market's quickly adjusted over the past year. Yeah.
Right. It's like you always hear about Las Vegas and Phoenix, right? It's like, they're the first ones to get hot and the first ones to get not.
Beautifully cyclical markets, but it's all about market timing there. Whereas here, it's kind of getting, it's hard work, and you gotta, you really do have to, know how to renovate a property. You have to know how to apply institutional property management to it. I mean, we have actually, last year was the first property ever that we bought that had RUBS in place, and the ratio utility billing system. That's property management 101 for apartments, right? I mean, it's just like the first thing that you do. And
speaking my language, and I don't understand.
And yet the mom and pop ownership, which is because of the smaller asset sizes here in LA, it's mom and pop owners because it's too management intensive for institutional investors. That's why we like it. That's why we do housing down in Latin America. The deals are too small for the big institutional investors, but we bring our institutional clients in. And one thing Paladin is really good at is scaling up small asset strategies where each of the investments have a lot of similarities. Align ourselves with firms like Beachfront, who have a lot of experience in the markets, and become real partners with them in growing the company kind of strategy. Awesome.
Thank you for that. That is, how did you get into international housing? I have to ask. I know it's not on our pre-scripted questions, but I'm so curious.
It was a little bit of creative persuasion on my part. It was a deal, a large master planned resort in Costa Rica that we still own called Los Sueños. And we had, Jim and I had been looking at some master plan resort investments here in the States, so we're very familiar with project level economics and so forth. And this particular opportunity, which came across my desk, was just the project level economics were off the charts, and the value proposition was off the charts. And So I kept running it by my partner, Jim, and Jim said no 2 or 3 times. And then I tricked him. I didn't lie because I don't lie, but I said, hey, there's some California home builders, which is true, in the conference room, because they were the ones who had tied up the property. And I said, just come in for a quick meet and greet. And I shut the door and I just said, 10 minutes. Just
stood there guarding
10 minutes. And long story short, Jim flew down that weekend. He came away with the same impression I had, that this was a killer deal. But we were owned at the time 50% by the family office of William Simon, who was Treasury Secretary back in the 1970s, and he was a leverage buyout pioneer in the 80s. And Jim had to do some creative persuasion with Bill to get this was our first deal outside of the country, but it opened our eyes up to the region because very little capital chasing opportunity down there. And we concluded, rather than vacation homes, that primary housing, workforce for sale housing, is the best way to play the growth opportunity down there. And fast forward 25 years later, we've developed over 40,000 low and middle income housing units in 7 countries in Latin America. We're one of the largest home builders down there. We are currently building the largest net zero carbon affordable housing project in the Western Hemisphere outside of Mexico City. And
that's awesome.
We're incredibly proud of that. I mean, we've been a very many of our investors are advocating ESG, environmental social governance. Mm-hmm. So we've been doing that for 20 years. So it's business as usual for us. And then we've kind of taken it up a notch to try to get sustainability and energy efficiency and ideally net zero carbon into the footprint down there.
That just sounds like fun. Maybe I'm sick. That just sounds like a really cool problem to solve and a fun thing to like a real estate adventure. Yeah, right. Yeah, absolutely. True real estate entrepreneurship there, Fred.
Yeah. Or a little bit of craziness too.
100%. I mean, if we were sane, we wouldn't be in here. We'd be employed by someone.
That's true.
So with that, there's all these complexities. What were some of your challenges of owning this large of a portfolio for this much time? Was there something that stands out the most?
I mean, one of the nice things about real estate, I mean, to do real estate investments successfully, I think it really is a combination of 3 things. First and foremost, which is good for me, it's common sense. It's not rocket science, this business. Experience matters. And then the third is hard work. And my partner, Jim Worms, and I have been at this business for 3 decades now. We've probably made every mistake in the book. And we try not to repeat them more than once. But that, I think that breadth of experience, 7 billion of real estate, 8 countries, 30 years, I think that gives us some pretty good perspective whenever we're making new investments. So, it's common sense, experience, hard work. It's not rocket science what we do.
No, it's just, would you say it was consistency? Is that what, if someone's trying to,
focus has been very important for us, Trevor. And that's one of the, we've done a little bit of everything, but the reason that 90% of what we've done is workforce housing and it's replicable investments that we can scale up is, focus really does matter. We've found. We really, it's got to be just a screaming deal for us to look at an out of the box opportunity.
And you found them.
Yeah,
we have found them. People say there's no such thing as the perfect deal. Well, if your rules of thumb are perfect to you, then such things perhaps exist.
It's true. Very true.
So Fred, earlier you mentioned you guys still manage some assets in-house, but I know that our company, Beachfront, and thank you for the compliment earlier. I didn't want to interrupt you, but thank you for the mention there earlier. How do you vet a property management company just from a high level view? And then how did you end up with us at Beachfront? What was that process like?
Trevor, we don't do the property management in-house.
It was the
company I started in '89
Is that what it was? Okay,
The,
this was
my
250. I
fraternity
heard.
brother's been running that since, and I'm just a advisor to him.
Okay.
So
My apologies. My correction.
everything we do is with third-party property managers, and that's important. I mean, our view is we want to, in each of our markets, we want to pick best-in-class managers, but they have to, they have to meet certain criteria. And the thing we like about beachfront is it actually reminds us a little bit about Paladin, because you've got institutional quality scale, teams, systems, infrastructure, but you also have an entrepreneurial element. There's a lot of creativity and agility to beachfront that you don't find in many firms that have the scale of beachfront. You mentioned, Trevor, corporate culture and values. I mean, one of the things I like about the culture that Kyle and the team have built at beachfront is it's very similar to Paladin. Do the right thing, promoting teamwork, perseverance as a trait, and yeah, and the team's working on our assets. They know our approach inside and out. They're experienced working with institutional capital, which is important to us. And so, I sleep very well at night knowing that our assets are in beachfront's hands.
Thank you for that, Fred. I appreciate the impromptu testimonial. Where I'm asked all the time, how do people find property management companies? So we ask them, and there's always a different level, a different path, but it all leads kind of back to Rome. All roads lead to Rome in a sense. It's communication, integrity, and for us, very much radical transparency, and the customer comes first, right?
Yeah.
Two of our
we believe in exactly the same things.
So, well, thank you for that. Thank you for sharing, Fred. And last question before we hit our lightning round. What advice would you give someone who's just starting or wants to start or somehow wants to get into the multifamily or commercial real estate game? What would be your best advice for that person?
Well, I look back at the portfolio that Brent and I managed back in the late 80s and early 90s, and how successful that has been for his family. The formula of buy, upgrade, hold for cash flow, and repeat it is a pretty powerful formula. I think the main advice I would give, particularly to younger folks who haven't been through a cycle or two, is to avoid the temptation to swing for the fences. I think you're going to see over the next few years a lot of deals that were done in the last few years when money was really cheap start to unwind. Take a page from Paladin's playbook, focus on assets that fill an essential need, and try to invest in supply-constrained markets. You may feel that you're paying more in terms of a lower cap rate, but if you know how to increase cash flow, those lower cap rates really reward value-added business plans. Focus on the left side of the balance sheet. Jim and I always tried to unravel an IRR when people would bring deals to our table. We wanted to see, how does the asset, what kind of returns on an unleveraged basis is that asset generating today, and where we're going to take it. That's the way we underwrite everything. And then we try to capitalize our deals with very conservative amounts of debt. We always use fixed rate financing, that we don't want a risk on the right side of the balance sheet to unravel great success on the left side of the balance sheet. And I think anyone who kind of follows those simple rules and applies some common sense and some experience and some hard work to it, you can't go wrong.
Those are the fundamentals, right, Fred? Those are the blocking and tackling, and there is no secret sauce to it. It's what you're saying. There's just a consistency and sticking with it.
Absolutely
staying in the game
right.
through the cycles, because the cycles happen no matter what.
Absolutely right.
Thank you for that, Fred. That was a great advice, because it's kind of advice I wish I'd heard, or somebody had told me once upon a time, a long time ago. I had to learn it through the school of hard knocks. right?
Yeah.
Still learning.
Well, Hard Knocks is the most powerful tool for sure.
I hear it's expensive to get into these days. Looking for a lot harder than it used to be.
Yep.
All right. Well, on to our lightning round questions, where I'm going to ask you, Fred, just straight one question. I'm going to be quiet. You're going to answer, and I'm going to say nothing else. We're going to the next question.
Boom.
And then we will wrap and be done, my friend.
Great.
Are you ready?
Yep.
What is your favorite book?
Favorite book I just read is The End of the World is Just Beginning by Peter Zion. One of the most thought-provoking books I've ever read.
Put that on my list. What is one thing that absolutely terrifies you?
Yeah, it's funny because not much does terrify me. I think probably the last time I was truly terrified was when I was out surfing and I was trying to figure out whether it was a dolphin or a shark that was swimming towards me.
That is a legitimate terrifier.
Yeah, it was definitely a terrifying moment there for sure.
Awesome. But number 3, you get to have dinner with any fictional character, live or dead, cartoon or otherwise. Who would it be, and what would the one question? If you could ask them one question, what would it be?
Boy, that's a great question, because there's a lot. I'd probably say the genie from Aladdin, because we could all use a few wishes granted, right?
Absolutely.
And I think I would have 3 questions I would ask.
What would be your first wish?
Oh God. World peace. Wouldn't that be nice?
Hey, done. That's all you need.
Wouldn't it be nice?
Donate the other 2 wishes to charity.
Exactly.
What is the best gift you have ever received?
That's easy. My 3 children, for sure.
Most people. If it wasn't your 3 children, what would it be?
Ooh. Well, then I'd have to say my wife saying yes in a crowded restaurant when I first, with all eyes upon her. I would have been really embarrassed if she had said no.
And let's see, what is your favorite failure? Not win, but what is like your favorite failure that you learned perhaps the most
favorite
from?
failure? Oh God, where do I start? I mean,
Gotta be one.
The whole 30-year history of Paladin has been a story of overcoming one failure after another. I mean, Trevor, you're in the property management business, so you know how common it is for curveballs to be thrown into the most well thought out business plan. And 100%. Believe me, I just every week there's a new curveball, whether it's property level or industry level. I like the roller coaster ride personally. So for me, we just pick ourselves up by our bootstraps and we keep moving forward. That is a big. You ask my kids, the two most important values for me, it's integrity and perseverance. Keep moving forward.
Keep moving, never stop, never rest. Keep moving. You're gonna fail forward. That's what my kids. Just keep failing until it works. Yeah. All right. And what last 2 questions, Fred? What one habit or stack of habits do you employ to set you up for success on a daily or weekly or monthly basis?
Well, you and I have talked about this before, and I talk a lot about this a lot with Kyle. It's one reason I like him. I'm big on family values. I'm big on corporate cultures that reflect those values. And the 2 biggest ones that stand out for me are integrity, doing the right thing, and perseverance, keep moving forward. And if you live your life and you run your business with those principles in mind, there's really nothing you can't achieve, in my view. And it's one of the things that I like about Kyle. It's one of the things I like about Beachfront is that we share, and I think our cultures reflect those same core values.
Thank you for that, Fred. And lastly, in the last 5 years, not 30, what new belief, behavior, or habit has most improved your life?
Well, I tell you, I think that COVID forced this upon me 3 years ago. And I've never been more productive. I've never been healthier or happier or more creative. And what I'm doing differently in the wake of COVID is managing my time for greater balance. And so I'm traveling less for business. I am delegating more to others. I am focusing more of my time on my family and my health and my golf game and recording some of the music I've written. And, there's not a day that goes by, Trevor, where I don't realize and have gratitude for how blessed I am to be able to say that COVID was a good thing for me, because it was so devastating for so many others.
Right.
But it brought I lost my status on American, and I don't care. I've got 3 million miles that I have. My wife and I are going to have fun using up. But I wouldn't trade the balance that I have in my life now, which is, it's just so enriching for any. And so
that is a awesome into our interview, Fred, because to end on a positive note coming out of COVID, because you don't hear that too much. And to have it so much so that you changed your life in a sense, like you brought balance back, it sounds like. Or
it really did. It really did, after being on the road 50% of the time for 20 years.
Wow, you traveled that much. Wow.
Yeah.
Well, congratulations on your life upgrade after the crazy that was COVID, right? You gotta look for the positives, right?
Love it.
All right, Fred. Well, thank you so much for being on our show. I know your time is very valuable, so we do appreciate it. And that's all we have today. Signing off, Trevor Henson and Fred Gortner with the best ever investment property insights, secrets straight from the pros. Yes, I know it's a new title every time. We might stick with that one this time. Hey, have a good day, everybody. Trevor.